Hi, I'm Lynn Adams.
I'm Justin Gross.
Welcome to this edition of Video Insight. This is our second quarter client conference call. Today we're going to be talking about things going on in the market, impacting your portfolios. Everything we talk about today is really for educational purposes only. None of this is intended to be construed as investment advice. We are advisors registered with Cetera Advisors Networks, and so we'll get started with that. So year to date, it's been pretty choppy. The stock market's essentially been flat or up or down, depending on which day you look at it.
Flat point to point, but anything flat in between.
Right.
January was fantastic. February, March, volatility's back.
Right. So we did send out a handout, so if you want to follow along in the handouts, on the first slide, we can give you the returns year to date. We actually left the 2017 returns on here as well, so you can kind of see the different categories. Through the end of the first quarter, the emerging markets were up 0.8%, and the hedge fund composite was up 0.6%. Everything else was slightly negative. U.S. S&P 500 was down 0.8%, and the bond market was down 1.46%. So it's interesting, though, depending on what day we look at these numbers, it might be positive or negative. It's just trading in this zone back and forth, plus or minus 1 or 2 from zero.
Yeah, some big market moves day to day.
Right.
700 points. That's, a couple hundred points may have been the norm, it feels like, recently. Mm-hmm. Some folks may be, surprised to see that with all the news that stocks get, that bonds were actually down more than stocks, but there's reasons for that, which we'll touch on.
But, I did leave the 2017 numbers on there because we did have a great year in 2017, probably a better year. We probably got some earnings, some growth in 2017 that might have been early. And
pushed forward a little bit.
Right, so we might not be getting much for a while because we got so much last year. This is a good time to talk about the S&P 500, the index for the U.S. stocks, and just to touch on the 200-day moving average, our hedging strategy. I know people are paying attention because they have been calling, saying, hey, we're at the 200-day moving average. Are we going to hedge out or whatnot? So now our strategy actually works to minimize downside, but we don't come out at the 200-day. We're slightly under the 200-day because there's a lot of institutional trades that take place at the 200-day moving average. So we want to be underneath that so we don't get caught getting out while institutional investors are pushing up the market on buys. This graph here shows you in the past 5 years, there's been 3 times that the market has traded below the 200-day moving average. And in each of these 3 instances, we actually did trade out. Wanted to point out that back in late 14, or right before 15, we got out, but it actually hurt us because when we got out, the market recovered and we ended up buying back in at a higher price, right? So it cost us, a % or 2 in that transaction as part of the process, right? But then when we move out to what occurred in, 15 and 16, when the markets went down at the end of 15, early 16, we went out, we stayed out, market was down longer, and the 200-day moving average went down. When we re-entered, it was at the same price or lower. So that one actually helped investors, right? Yep. So we're now flirting with the 200-day moving average, and we haven't yet come out because we haven't breached the threshold below it that triggers us to move equities off the table. But we did want to just point out that there's really 4 outcomes from the strategy, right? If it goes down under the 200-day moving average briefly and pops back up, then we can get what we call gapped out, and that can cost us a % or 2 of a loss, which is certainly far less of an outcome than having the market go down 40, 50% and we lose a big number. If it goes down and stays down for 60 to 90 days and the 200-day moving average drops lower, then when we re-enter, as we come back in at about the same price, then it's really a non-event, right? It doesn't cost you, doesn't help you, doesn't hurt you, but it does feel good when you turn on the TV and there's all this noise about things are terrible and you know that your equities are not in equities at the moment, right? Yeah. And then the third option is the market goes down, and it goes down a ton, which we know happens every 15 years or so. And when that happens, that becomes a good thing for people using our strategy because our re-entry point will be much lower coming back in. And then the fourth thing, which is not statistically likely going to happen, is that we never see the stock market breach the 200-day moving average and we stay in always and forever. But I don't think that's very likely to happen.
It's important to know that when we get out, you never know what the future holds. You don't know if it's a blip, like back in 14, short-lived and we're right back in, or if it's a big one.
Right.
But I can live with the get out, get right back in. I kind of call it a paper cut, right?
Right.
As opposed to a more buy and hold strategy where it's just hang on and don't do anything, don't panic in a severe downturn. Those hurt.
It's hard for people to stomach that. You may turn out fine in the end, but boy, it's not a fun ride, right? Let's switch gears and talk about the recent volatility. So it's interesting. As Justin mentioned, we're having more volatility this year than we've seen in quite a while. The reasons are more than what the news is talking about. Obviously, President Trump tweeting and lighting fires and creating, that's one piece. But really, there's an earnings debate, right? So the new tax law came into play January 1st. We know that corporate America has a big reprieve on how much taxes they're going to pay because of the changes in corporate tax. So analysts can actually determine, well, what does that mean for earnings? And so, the price to earnings ratio right now, for example, on stocks is around 16.4 times earnings. That's a very attractive multiple, but it's because the analysts have said, well, here's what it's going to be after the new taxes. Well, until investors actually see the more robust earnings physically materialize, which should happen in the next 3 weeks, we'll start to see that, then it's kind of saying, well, it's going to happen, we haven't seen it. So there's sort of this skepticism that we're really going to see corporate earnings improve because of the tax rule. So that's happening. And then there's another piece that's creating this tug of war, and that is that, okay, 2018 looks like we could have a decent year from a valuation standpoint and earnings, coming out higher with the tax law and so on and so forth. But as you look further down the road, 2019 and almost as far as the eye can see, you really have a difficult time saying, well, where is the growth going to come from in the future, right? So if you turn over to the next slide, we'll talk a little about that. This slide that says diminishing workforce. What you're looking at here, top left corner, this shows us the number of working age people in our American society, and what we're going to see is the next 10 years, the growth in that population is minuscule. In fact, 3 out of every 4 new workers will only come from immigration. They won't be born in the U.S. We just have so many so few people born in the period of time that would now be entering the workforce relative to how many people are leaving, that we have a very big demographics problem.
Yeah, the baby boomers segment that's kind of leaving, going out the door. There's just nothing there to replace that many people.
Right. And so the chart right below that where it says growth in private sector, non-residential capital stock, this is basically a graph showing you the investments that corporations make in the technology that makes more productivity happen in the workplace, right? So you can, to some degree, you can replace labor with technology, but there's not been enough capital spending to really be prepared to replace that much labor, right? So if you look at the right-hand side, this is the GDP growth drivers. Last 4 or 5 decades, GDP in the U.S. has been around 3%. That's just been a number that we've been able to obtain, and a large part of that is from workforce population growth as well. But now we're looking forward, and all we see for as far as we can see is the potential for 2% GDP growth. So if you think about it like this, GDP at 2, dividends around 2, possibly consumer confidence, investor confidence increasing, and you get a little higher multiples on your stocks, you might get an extra 1 or 2 from that. I mean, you're looking at 5 or 6% average annual return for stocks before expenses.
Right, and that's trying to look at a kind of a rosy scenario. I mean, mid single digits for U.S.
And that doesn't account any of the bad things, right? Like war or terrorism or you name it, scandals. So we don't see 19, 20, 21, 22 being good years, and I think that's one of the reasons you're seeing some skepticism here at the institutional level to bid stocks up further, right? If you switch over and you look at the bond market, well, the case isn't any better there, right? This next slide, rising interest rates. This is just showing you that the Federal Reserve and the general bond market are forecasting interest rates to continue to rise. 7 of the current Fed chair regional leaders have said they see 4 rate hikes this year, right? Now, the market seems to think it's going to be slightly less than that, but any rate hikes make bonds lose value in the short term, right? So we're concerned that if you've got stocks on one side that have a limited upside because of demographics, bonds on the other that have, I'm not sure how bonds are going to make money at all, with interest rates rising to a more normal long-term level, it's going to be a difficult landscape to navigate.
It's definitely going to force portfolios to look different going forward than they have over the bull market run.
Right.
It's a logical thing. A cycle doesn't stay the same forever. It turns.
Right.
So there's still ways to make money and ways to construct portfolios, but it's not going to be the same.
It's going to be a little different. I mean, I can see the use of convertible bonds in lieu of traditional bonds. I could see the use of more high yield versus investment grade. You could see fixed annuities in lieu of treasuries. There's things that you can try to substitute, but it's going to be different.
In those, I mean, and there's ways to transfer that risk.
Right.
If we're identifying these risks and we don't like these risks,
right,
maybe you can transfer those risks.
So let's look at this next slide. We haven't really talked about this on a conference call before, but if you have a high conviction that interest rates are going to rise, and then you go back and you look at, well, what kind of stocks should we own? There's certain sectors that do better when rates are rising, and certain sectors that do worse when rates are rising. So different kinds of sectors. If you look at this slide, it shows us the correlation to yields. Financials is really historically the best performing sector when it comes to having the stock price go up at the same time that rates go up. And that makes sense, because banks can make more money when rates going up, insurance companies make more money with higher rates. There's a few others that have positive correlations. I think industrials tends to be decent, and materials as well. But you want to be careful when you're picking your stocks here. Real estate, utilities can be very, very, very challenged in a rising interest rate environment, especially from the current price levels. I mean, real estate's at an all-time high.
Right.
You're seeing a lot of bubble-type activity there. So we're conscious of this when we're looking at funds and positions. One other thing that's an interesting note is that indexing can actually underperform active managers in this kind of cycle, right? Because you got to pick the right sectors versus having a basket of everything if you have interest rate risk that seeps into stock prices.
There's a lot of potholes, as I call them out here. I mean, because even if you go to say, okay, well, I don't like volatility. Who does? Unless it's to the upside. I'm going to go with a minimum volatility portfolio.
Right.
Well, you may end up owning utilities.
Right.
You may end up owning
real estate.
Real estate. So
you got to pick your poison.
The marketing department will trick you.
Yeah, that is true.
So
you have to really stay alert. Some other things that happen when you have rising interest rates. This is a slide here that I just thought was interesting. So the composition of the bond market itself, like when you look at the Barclays Ag, in the last few years, the average length of time to maturity in the notes that are in that index, the duration has increased. It's almost, I think it's about 6.
Over 6.
Yeah, it's over 6 years now. So basically what that means when you read duration, it says if interest rates go up 1% immediately, this is how much you would expect to lose on that move. So if interest rates go up 1% tomorrow, then a duration of 6, I mean, you would lose 6%. And that's a pretty hefty downside for the bond index, right? And so what's happened is investors have increased the duration. They're willing to take interest rate risk because they're yield hungry, but they're doing it right at the wrong time when we're really right in front of what could be some significant rate increases.
Yeah, it's an important time to take a look at your portfolio. I mean, because people buy bonds for safety or income. Mm-hmm. You don't buy a bond to lose 6% off of a 1% move in interest rates. If we see some from time to time folks in target date funds, the income fund, which is a historical age-based factor investment. But if you're 60, 70 years old, and they're loaded up in bonds, this may be in play. So you got to know what you own.
That's
important
really
right
important. It is more than it's been in a long time. Now the good news is, once rates rise and we get up to a more normal interest rate environment, 10-year Treasury mid 4s, give or take, then we're in a great environment again, because then we
Right.
can actually get paid something while we're sitting in a safe piece, but right now the yield's not high enough to offset the duration risk. So that's something to keep in mind. Where is a bright spot is international. International stocks, the world economy. If you look at this slide on international stocks in a simple way to read it, from the bottom of the market to current, international stocks are up 123%. That pales in comparison compared to the domestic market that's almost 300% from the bottom, right? Not only has it not recovered to nearly the same degree as the US, but the price tag for international stocks is much cheaper. They're selling at 13 times earnings versus the US is at 16 times earnings. So there's a better value, cheaper price to pay. And then third, their dividends. The dividends on the average international stock is around 3%, where in the US it's around 2%. So there's a lot better value outside the US right now in owning international stocks. So we think it's really important to have more international now than probably we've had in 10 years, right?
More diversified, just by definition.
More diversified, a lot of the same kinds of companies. Every day we consume products that are made from companies headquartered overseas. We don't even think about it, but it's an enormous number of opportunities there.
Yeah.
Another thing that I think plays into this international theme is that there's a lot of talk in the last few weeks about tariffs and the trade deficit and how the U.S. is buying more goods from overseas than we're selling to overseas buyers. And Trump's talking about tariffs and things, and I get all of the pieces to that and why he has that position. But what everybody needs to realize is that a tariff of a small percentage on goods coming in from overseas is a minuscule impact on the trade deficit relative to the strength of the dollar.
Right.
And when this, or if this leadership decides they really want to go after the trade deficit, they'll devalue the dollar, and then that will correct the trade deficit. And that's what most economists think is likely to happen. But if the value of the dollar goes down a little bit, if you own international assets, then you make money on that dollar change in value, right?
Yep.
So that's important also to understand when you're thinking about the case for international. And then the third piece is this chart. This is the global heat map for manufacturing. This is a little different way of looking at it, but we're showing this regularly. But every country that's measured for manufacturing output is in the green or improving from years or decades in the past. So the global growth story, the manufacturing output, the consumption is very, very good. And I think we just need to continue to stay focused, that we as U.S. investors need to continue to look overseas.
Yeah, I feel like in the first part of the call here, we've tried to identify some potential problem areas. There's a lot of good things out there too.
There are.
That you can get in.
A lot of them just happen to be non-U.S.
You're not going to see them on the nightly news.
No.
Maybe, but
not unless you're traveling abroad, right? So just as wrap this up, some conclusions here. Growth in the U.S. is probably going to remain slow for the foreseeable future. Demographics are an issue. The lack of spending on technology to replace jobs is an issue. But there's another issue too. Companies in the U.S., I think in this environment, would rather maintain their margins than to lower their margins and pay for more expensive workers. So I can pay more expensive workers and I can grow, but I'm gonna have to do it at a lower margin, or I can stay operating at high margins and stay lean and stay financially healthy for an extended period of time. And that's the choice. And I think that you're gonna see more people, more companies say, we're just gonna stay high margins and operate like we are. And because of that, I don't think you see a lot of growth happening. I think status quo is going to be the norm. Higher interest rates will also hurt corporate spending. If they got to borrow money to buy new technology and new equipment, higher rates slow that down. So I think we're going to have some growth issues, just super slow growth. And as an investor, the third bullet here is that you're going to have to really look at your sectors. You can't just buy baskets of things and think all is created equal, because in the rising interest rate environment, all is not equal, right? So there's some work to be done there on the equity side.
Stock and bond market.
Oh, absolutely. Bond market even more important, but most clients tend to be fixated on stocks, right?
Yep.
International, we think will remain high relative to historical norms. I put this other bullet in here just to remind people that, okay, so when things seem like there's not a lot of money to be made, I had a client call and say, you know, we only made, you know, 7 or 8% last year and 6% the year before, and I got this opportunity to go do this land deal with my buddy down the street, and we think we can make 20%, right? Well, I think that's an exotic type of investment. You know, it's unique. It's not. It's a specialty thing, and it may work. It may not. But I think people tend to look for more creative ways to make money when they're not getting paid big returns with their securities portfolio. But I encourage you, if you want to look at exotics, to look at the risks associated with the sector. Like if it's real estate and interest rates are rising, that could be a really bad problem, right? But be careful with these exotic investments. There's a lot of, you know, venture capital things. There's some internet-based, you know, let's all put $10,000 in a pot and go start a new program, and you know, there's things out there.
Yeah,
right?
and I hate to call it common sense, but just we always talk about reversion to the mean. Look at how it's performed and where that may be in a cycle.
Right.
You know, so important.
Downside could be pretty tough. And then the only thing I would say that we might do here is a little different, is this looking at some 5-year structured products. I mean, I was telling Justin the other day, I was like, I wish we could just take everything we've got right now and freeze it and fast forward 3 years from now, where interest rates are probably going to be 1.5% higher, because then it's a lot easier to operate.
Yep.
But we got to get 3 years from now, and we got to go through that tunnel. And we may look to do some things where we're doing some fixed products, some fixed annuities, some fixed interest things for the next 3 or 4 years. It may not be super high returns, but at least make something on some part of the portfolio in the fixed income side while we go through this interest rate change. We might be doing more of that.
Transferring that risk,
Again,
like we talked
right.
about, and knowing what your risk and your reward is. Those, I mean, that's any investment. That's
Right.
the core of any investment. So it's something we don't look at.
So that's sort of it for today's call. We will take questions by email. Feel free to email anytime. Mine is ladams@adamsfp.com. Justin's is jgross@adamsfp.com as well. We appreciate the opportunity to serve you and your families. We're working really hard to make sure that you've got the right type of portfolio set up. You've got hedges on the equities. It's a little bit more unnerving this year because the market's bouncing around a little bit, but we got you. We got a handle on things, and we're going to be fine. But we do have to navigate this next cycle with a little bit more diligence to make sure that we can squeak out any returns that are there to be made. So with that, Justin will run through the required disclosures.
Keep in mind that while diversification may help reduce volatility and risk, it does not guarantee future performance.
The views are those of Adams Financial Partners and should not be construed as investment advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. All economic and performance information is historical and not indicative of future results. Please consult your financial advisor for more information.